Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our April monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So a lot to cover. We'll jump right in. First of all, we hope to see many of you here in just a couple of weeks at our quarterly investment forum at Perry's over lunch on Wednesday, April the 24th. We also thank you for those that participated in our recent estate planning love letter webinar on March 21st. And you should have recently received our next webinar invitation to our webinar on AI on June 26th at 11 o'clock. So we hope that you'll be able to participate in that. You can find out more information about that on our website, and you should have received an invitation as well. Congratulations to our team member, Sharon Harris, who celebrated 2 years with us, serving our amazing clients in April of this year. So markets through the end of Q1 remained high, although they backed up a little bit from this 5,200 point level on the S&P 500 at the end of Q1. So kind of what are some themes that we're looking at? We'll talk about inflation, Fed, and kind of the narrow market participation of the Magnificent Seven and whether there's signs of that broadening out or not. So we'll start right with it with inflation on Wednesday, a much hotter than expected print on inflation. The markets responded negatively on Wednesday to that. We're looking at a 3.5% CPI year over year through March. Again, that was hotter than expected. So what that calls into question, we'll talk about this more in a second, is when and how much will the Fed be cutting rates in the back half of the year? Markets predicted following the CPI print on Wednesday, went in from pricing as June cut to September and lowered the outlook this year to 2 from 3. So our feeling all along was the Fed was going to cut in the back half of the year. How much and when that would start it was always in question. Those that were predicting 3 to 6 rate cuts, we always believed that was too aggressive. But again, with the CPI print yesterday, the likelihood is now September, and the likelihood is now closer to 2. If we look at inflation print, the pace of change has slowed. This will fill in at 3.5% once this chart is upgraded, down from peak in summer of 22 to 3.2 in February, 3.5 in March. So what are the implications of what the Fed does next? So the Fed's kind of in a balancing act of holding rates too high for too long. Evidence is more cracks in the economy. Cuts rates prematurely, then inflation kind of reaccelerates. And again, with the hotter than expected print yesterday, the likelihood is now pushed back on how many cuts we'll get this year and when that will start. Just for historical measures, the average length of time between the Fed's last raise and the first cut is about 11 months. That put us in summer of 23, if average is what happened. And kind of speaking to the less likelihood of cuts, the Minneapolis Fed president, Neel Kashkari, said recently that penciled in 2, but if inflation continues to stall, there may be none required by the end of the year. So again, with the CPI print on Wednesday, the likelihood of rates when they start being cut by the Fed and how many are definitely, that's pushed back and it's lower now. So participation beyond the Mag 7. So there's a lot of busyness here, but basically what this shows is that 60% of the S&P 500 performance last year was these 7 companies: Apple, NVIDIA, Microsoft, Amazon, Tesla, Alphabet, and Meta. Now, their participation thus far in performance this year at 36%, driven by 7 stocks, is still a lot. But it is down. So this does evidence somewhat of a broadening of market gains, down from 60% of the performance of an index in 2023, down to 36. In terms of GDP, last print on Q4 was just over 3, so the economy continues to be in growth mode. Because the consumer drives 70% of the economy, it's worth looking at how they're doing. We've talked about this before, how debt service is creeping up. So about 10% of income is used in service of debt. That's way down for 2 reasons: the amount of debt and the debt service cost of the debt has gone up with rates going up. And then you see increased delinquencies on loans, specifically in auto and car, up pretty dramatically through the end of 23. We'll talk about why that is in a second. You've also seen all of this excess savings, in essence, burned off that was accumulated during COVID. And savings rates are way down. And part of the reason debt service cost is up is because debt is up. So credit card debt reached 1.13 trillion in the fourth quarter of 2023. So the consumer, which drives 70% of the economy, some of these things are flashing warning signs. Jobs report was overall pretty good. 303,000 added. The most recent jobs report, unemployment rate of 3.8, and average annual income growth at 4.1. Speaking of debt, the government continues to run deficits as far as the eye can see. This is the current amount of debt as it relates to GDP. So that puts us back, near where we were during World War II. And based on CBO projections, we just do nothing but continue to go up. This will reach a friction point at some point. Right now, there seems to be no appetite to curb this whatsoever. Again, right now we sit on debt to GDP about where we were during World War II. So there's reasons for optimism and pessimism. We'll kind of talk about them both. The reasons for optimism is we continue to get growth and avoid a recession. The Fed cuts interest rates. So even though we know that's probably pushed back and will be less cuts than maybe anticipated a few weeks ago, the Fed does cut. That is ultimately a tailwind for stocks. Market performance continues to widen. We're seeing that happen. And this could be both the reasons for optimism and pessimism. We're in earnings season, which is the second week following a calendar quarter, with the big banks starting the reporting on Friday of this week. So again, if earnings beat what the market's already priced in, that could be a reason for optimism. Pessimism is we do see a recession. The consumer weakens. We've talked about some indications of that. And the Fed Reserve now cuts rates less than expected, or even possibly not at all in 2024. Geopolitical is always kind of a risk that can manifest itself. And the pessimism, we put this in here as well, which is earnings season, which starts this week, disappoints or isn't as good as the market was anticipating. So we'll end with a couple of things regarding geopolitical, most recent being the Russia-Ukraine war. In terms of what the average sell-off was, the size of the sell-off, and the duration of trading days to recovery. This is just meant to point out that over this 50-year period of time, on average, you trade off 9 days, down 5%. And by 11 trading days in, you're back to where you were before these geopolitical events. So while they're all worth noting and they're all relevant to everything we look at as it relates to capital markets, it's important to look at these in context over the last 50 years. And then we're in an election year, as everybody knows. This is just the average performance going back almost 100 years over the quarters in an election year on average. So we tend to see kind of a muted but positive first half, and then a better second half of the year during an election year. We will be rebalancing and sending out trade notes soon regarding the details of that. This will be kind of taking our targeted allocations back to a defined allocation, and also investing in themes that we think are opportunistic in this environment. So look for those trade notes coming to you soon, followed by a rebalance. So none of this is a replacement of contacting us and speaking to us directly about how all these things impact you. So feel free to give us a call. We're here to serve you. Please do not leave any question unanswered. We're here to help. So with that in mind, we'll close. Again, we want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent serving you. We hope to see many of you at our quarterly investment forum at Perry's here in just a couple of weeks. Until we see you again, be well and take care.